from that perspective, I think very clearly. So if I look at the max entire split into three parts, one of the parts was to get into the insurance space with another JD, and I think that's why they did what they did. Converting it into three different parts. So if you look at Adani, they did the three parts of the power transmission, the port trust, SEZ port trust, that. So all of that is important, because what you want to gain out of what is how I will look at that issue. So moving into basically some examples now. The first example is about slum exchange, and I think this concept of slum exchange got developed in a very different context. But obviously, why is it relevant? Why is it important? And why would you do a slum exchange and not do a slum sale? Is very important to know. So, you have a seller entity which is transferring one unit to the buyer entity, and in this exchange, because you are not paying cash, you are going to issue redeemable preference shares and non-convertible shares for the business transfer. You could do this either through a private route or through an NCLT approval, choice is yours. But does it give us a good answer if you do a slum exchange? Because the cash is not being paid now, cash will be paid later. What does it say? So the issue is that for the seller entity, there is a potential argument to say that slum exchange is not subject to capital gains. There is a Bombay High Court decision in this case which favors this proposition. So if you have to save the tax, then you might think of a slum exchange. Now, if you are a company, the question that comes is it going to save you tax? Because you are also subject to minimum ordinary tax. And how are you going to ever be able to avoid making profit to the P&L when you make a sale of a business? But it again depends on your facts, because if you are selling a smaller undertaking compared to a larger business, your ability to consume it in the profits of the larger entity, and therefore your additional mentality may not be very heavy or may not be there. Even if it is not, even if it is slightly there, your absorption capability in the next year or two is so high against your normal profit that you will still want to consider it. So while there is a MAT issue, but I think one can look at the facts and see whether the MAT issue is a real issue or whether it is something which is absorbable. And how do you go around it? The aspect is under guard what you going to have. Because I think 70 days more and you might face that reality. Though there are claimers that it should be pushed by 1 year, but assume that it doesn't happen, then you are faced. So what do we do under guard? How do we structure this? What do we do? Because it's very important, right? So one of the commercial aspects that comes to mind is that does the buyer have the money? Does he need to borrow? Or can he say that the transaction is structured only to be paid out of the profits he makes out of the undertaking that he is going to ship? So I don't want to carry the risk as a seller. He is willing to carry the risk, but he is willing to pay as he earns, and maybe slightly better than as he earns. But he wants to see the color of money before he starts paying. Is that a logic that one can develop? Because then it becomes a commercial point. And from commercial perspective, if third parties are there with this type of logic, is it a good enough answer? I think is something that one will have to work on. So one can look at it. I am not too sure that just because you come out of the slum sale section of the Act, I is still not covered under the normal section of 45 itself. Because if you are not in a specific section which taxes you in the capital gains chapter, you should go back to the normal one, which is the basic one. And all the decisions that are there, including Supreme Court decisions, are held by business to be a capital asset. So why would I not tax you under a normal one? Today if you had shares and you swap that shares for something else, not under a merger but outside a merger, wouldn't you be subject to capital gains? It is an exchange. So why would I not be subject to capital gains under 45? That to my mind has not been challenged, asked, questioned. Okay, it's not 50B, I want to go under 45. If somebody raises that, then this will have its own challenge. Because it doesn't say that you will not be taxed under 45. 50B doesn't say that, because 45 still exists. So that's going to be the key thing as to be looked out for. This is another innovative way of transferring your jurisdictions. So we have a holding company and it incorporates a new company in a tax efficient jurisdiction. Now there are very few of them. Still Netherlands is there. And then their original entity which was there in a non-favorable jurisdiction. What we do is we basically transfer the India unit to a subsidiary of the newly created FCO. Now, generally under demerger, the resulting company needs to issue shares to the shareholders of the demerged entity. But the way the resulting company definition is defined, it also covers its holding company so long as it is a 100% holding company. So you demerge it into the 100% boss which is in India, because company that does not permit outbound mergers or outbound demergers yet. But the shares are issued by the holding company outside India to the shareholders of the demerged entity. So long as they are non-resident, doesn't matter. And accordingly, you have got the structure realigned. Because you now hold the Indian company shares through a foreign company which is in a jurisdiction that you wanted. So let's say if you are able to by March 31, 17, you will still get the grandfathering under the several treaties that are amended. And the question is, can I get a scheme so quickly approved? Is there a possibility before March 17? Then the answer to my mind is no. Because the way things are moving there, it's just started to, so it's in the first year, moving slowly into the second year, I can call it. So that's very important. So can you do this? Can you not do this? But what happens if your foreign company is still Netherlands? So because there, we've still not seen a treaty change. So for potential answer there lies that can you shift to Netherlands? But if you do it under RAR, then what happens? Because assuming this will happen only after April 17, so by the time you get the NCLT order and all of that, is there an answer? What do we need to do to be able to meet any questioning that can come under RAR? How do we create that governance around the new foreign company that we have created? What is the basis? What is the rationale? I think it needs to be built in. So is it that I'm shifting my base to Netherlands? Is that a good enough rationale? Is this the only investment that I'm taking? Is it all about realigning my worldwide investments? So I think those are the type of issues that we will have to start digging into to see whether we can get a good commercial perspective to this answer. Cash repatriation to buyback. I think in primarily listed company shares, we did not see too many buybacks happen earlier. But of late, I think there is a lot of companies looking at buyback, especially if you are held by a foreign entity. And why is this now being seen quite a bit? It's because I think in July of 2015, August of 2015. There was a change in law by SEBI. SEBI earlier did not permit promoters to participate in a buyback if it was done through stock exchange. In July 15, they started permitting promoters also to participate in buyback offers to the stock exchange. Earlier, promoters could only participate in a normal tender offer, not an offer through stock exchange. So once this law changed, then in the budget last year, it came that foreign companies will not be subject to MAT. So these two put together provided the advantage of buyback versus dividend. Because if I have to do dividend, then there is 20% on the amount paid as dividend or 70% on the loss. But if I do a buyback, if the shares are held long term, then the money reaches at least a foreign person totally tax-free, just that HTT is paid. It is very, very small. So there is a huge 20% saving, and all your accumulated profits of the past, you could do that. Plus, earlier, there was a transfer to reserve rules where you had to pay dividend, and you could only, pay 90% of your profits. Again, companies had removed that barrier. So now you could even pay up to 100% of your, profits as dividends if you want. So there was a huge accumulation of the past because of a 10% transfer to reserve, which were not, payable as dividend. You could not pay dividend out of it because you have to again follow the declaration of, dividend out of reserve rules, which again gives the amount. So you use the buyback. So a combination of these three, provided an opportunity to think through this and give this as a solution where at least monies are paid in a tax-free manner. Does this work in an Indian scenario? Yes, it absolutely works in an Indian scenario if the promoter holding is not through corporate entity. Because if, let's say, a promoter is an individual or a group of individuals or a family or a trust, as we just heard, that people are aligning to trust also, or LLP not proper trust, let's put it this way. There also there is no MAT. You just pay the STT and you take the money out. And this is the way to reward more by 20%. So if I wanted to pay 100 to my shareholders, I could have only paid 83 because I had to pay 20% tax on 83. Now I am able to give that 17 back to my shareholders. Or maybe 99 point, not 17 but 16.8 because the 0.2 will go in the STT. So you are rewarding your shareholders much more. That's a possibility that is now available. So one can look at this from that perspective also. But again, if you are going to do buyback after buyback, it's not going to be looking good for any corporate. Because I think you must also understand there is a market sentiment, and if you are going to reduce your capital, the market will not look at it as favorably as what you want to. So I think you need to balance that, and I think merchant bankers need to be conservative in terms of the larger impact that it can have. But broadly, I think if you are able to communicate to the market that this does entail a lot of saving, and the quantum of money that is available is not going to be used for business, and therefore it is returned to the shareholders, I think you will be able to drive this return. Issue of bonus entities, I think we've seen that in the past. Some companies do that. I think 2 or 3 aspects here. I mean, one is that obviously this is subject to dividend distribution tax. Oh, if it is subject to dividend distribution, why should I do it? I mean, that's the first question that comes to mind. And you are asking me to pay, 20%, and what am I going to pay? But the potential here is that you will pay an interest on that entity, which will be normal market rate. That is allowed to you as basically deduction against your expenses. And for some of the foreign owners, again, the withholding tax rate may be much lower, and therefore their ability to absorb this may be much better compared to a 34% tax in India or 30% effective tax rate in India. Because the highest tax rate on withholding is now 10%, that's what the domestic policy. So there is an arbitrage here again in terms of taxation in India versus there, and this has been used in the past. And I think the question that will come is that what will happen when dark kicks in? Will this type of schemes will go through? So I think the answer to that is that if it is a listed entity, you are providing your shareholders with a mechanism to encash it. Is that a good commercial rationale to have? I think one will have to dig deep into this and debate see whether there is a good reasoning to make it happen. But again, commercial aspect will have to come into play. That on one hand, I want to keep on rewarding my shareholders, but I don't have the cash immediately to pay, so I am committing to pay them after a point of time. In the interim, I am going to pay them whatever is the rate of return that I determine on that, and does it therefore help overall? Cross-border merger, we just spoken about the issue. Again, this I think we have spoken about exit of foreign investors by merging the holding company into the group. The other one that we see very quickly is leverage acquisition. This I think is important because if the seller is wanting to sell only the company, and we as a buyer are wanting to do a leverage acquisition, we would obviously, apart from putting in money, borrow and buy the share. Now, banks in India do not give borrowings for buying shares. So therefore, what typically happens is that you go to an NBFC, do your transaction, and the date of the transaction you also announce the merger of the company into yourself, and then replace the high cost NBFC borrowing with the bank borrowing, because then it's a replacement of a borrowing, and as well as the merger coming into play. Once you do the merger, the key question is that can I get deduction of the interest? Because what I was doing is only acquiring the business. I had documented it that way. I had always planned it that way. It's only that because the seller's insistence that I needed to sell the shares. Second is, on that merger, because when I am paying a price for the shares, there is always a goodwill element built into that shares. Now, when I do this merger, can I record it at fair value and claim depreciation on the goodwill under SWIFT? So subject to debate, but today there is a law. I may like it, I may not agree with it, I agree with it. There is a law, at least it's worth making a claim. So I think those are the type of issues that come, and how do we try and create commercial answers to some of those questions? As Ketan said, whether it is literal GAR or whether it is judicial GAR, I think the commercial rationale needs to be important, because in either situation, I think that is what will come into play and help us. Dual residency, I think this is one change in the math, and I thought we should just quickly cover this. So we have a UK company which is a tax resident of Cyprus and has got a TRC from the Cyprus authorities, and its entire business operations and everything is in Cyprus, employees and therefore its place of effective management is also Cyprus, and its tax assessments are in Cyprus. Up till now, I think it was very clear that if this Cyprus company were to sell shares, or if this UK company were to sell shares in India, I would look at India Cyprus because of ERC, place of effective management. However, under the BAT Section Plan 6, once the multilateral instruments are going to be notified, this will all change. Then the power to determine where this company is tax resident will lie with the authorities between UK and Cyprus. And for any reason, if they come to a conclusion that it is tax resident of UK, then the India-UK treaty will be there. So whatever planning that you have done, whatever you have created substance, in such a scenario might not go good in future. And it's very important to just understand and know this, because we may plan on a certain basis today, but in 2 years' time or whatever, when those multilateral instruments are going to become a reality, I think it will become undone. So please be aware about that, and it's more of information. It's not in play as of now, but I think this is very, very important. Because the tax residency will no longer be on place of effective management. It will be decided by the authority of Cyprus and UK in a scenario like this. So, for example, today again, Unilever KLC is a UK-based company, but primary operations are from Netherlands. So, which treaty to apply? It's going to be very, very interesting. Mauritius protocol, I think I'll just skip that in the interest of time. moving on to the business combinations, primarily, basically, I think when I look at India's 103, I think there are 2 or 3 elements that need to be kept in mind. The transaction or an event where control is acquired, whether it is one or more businesses, important element is control over business. How is control defined? The power over the investing company. What are the type of rights you have? What are the powers you have to determine the rate of return on investments? Business again has been defined to basically mean an operation. If I were to put it in a simple manner. Now, these 3 elements are very important going forward to determine business combinations. And what does this do? So, if I were to do a quick comparison of the scope between Indian GAAP or AS14, which is still applicable to some set of companies, including financial services companies, then there is no comprehensive standard under Indian GAAP. Only we have AS14, which is used in amalgamation. There is no standard for demerger, but we generally try and rely on the amalgamation standard. Index covers all types of situations, whether it is a merger, whether it is an acquisition, and demergers here are covered under a sort of an acquisition nomenclature under Index. It does not cover joint ventures, and it does not cover a pure play acquisition of any asset. So if I acquire a brand, then it is not covered, because by itself it does not constitute a business. It is not an activity by itself. Then let's go to accounting for common control transaction, and now I think the issues start. Up till now we are very used to whatever accounting we will describe, whether pooling of interest, whether fair value, under Indian GAAP it was all free. We had to decide. Going forward, if it is a common control transaction, then only pooling of interest method is possible. There is no other method. And there are several combinations within this combination. What is a combination? What is common control? What is not common control? So, for example, if you just step back, I took an example where I am acquiring a company and then I am merging that company into myself. So, when I am merging that company, it is my wholly owned subsidiary. So, would it be a common control transaction or would it not be a common control transaction? Sorry?
Common control.
So, India says it is not common control. Why? Because I acquired that company from a third party and I have always neglected too much. So, they would assume that I have acquired the business from day one. Because substance over form is I wanted to acquire the business. It's only been done in 2 steps. Share acquisition and then folding it into myself. So again, very, very different.